Futures spiked this morning alongside Treasuries after the Treasury announced that they were doubling their buybacks. 30 minutes until the start of trading. I'm Dani Burger. Bloomberg Open Interest starts right now. Coming up, Target and Lowe's add to a mixed bag of retail results, with Walmart still to come. A major vaccine milestone, shares of Moderna soar with a melanoma trial win. And Treasury's buyback boost is powering a pullback, I should say, in long end yields. So that's what's powering the overall market so far this morning, that announcement from the Treasury. On the downside, though, we have some earnings to work through. And the big box retailers coming out in force. Target lifts its full year guidance, but shares fell as investors were hoping for a bigger earnings beat. Lowe's cut its outlook as the sluggish housing market weighs on sales. And TJ Maxx owner TJX sales beat estimates and announced plans to expand its global footprint. Let's get into all these. Joining us now is Bloomberg Markets correspondent Nora Melinda. Nora, it feels weird to say that expectations were higher for Target because this is a company that kept missing and kept having poor results. And I guess the turnaround's taking hold, so we need to see more of a turnaround?
I mean, we did see 3 back-to-back years of declining revenues, so it's interesting to see the run-up in the stock, up about 56% year-to-date heading into this report. So this is clearly a sign that the CEO's efforts to turn around this company may actually be paying off. You're seeing consumers coming into stores and the company leaning into more innovative ways to really attract and keep consumers here.
So you have that, and then you have Lowe's too. I guess a completely different story because this is so tied to the housing market.
Right. And so Lowe's, of course, we have to think about Home Depot earnings, which was reported yesterday as well. So Lowe's is actually focused on the DIY consumer like myself and you, whereas Home Depot is focused on the contractor. So what you're seeing here with Lowe's is essentially still a pressured consumer. So they're not necessarily having a hard time bringing in some of those contractors, but they are struggling to get those consumers to actually want to renovate their kitchen right now when, of course, money still continues to be tight for a lot of American shoppers. And so that still continues to be an overhang on this company. And what you're seeing analysts on Wall Street saying is that we're going to essentially need the housing market to thaw. We're going to need to see more job growth, wage income increasing, but then separate from that, rates coming down. And of course, we do know that the 30-year fix right now is sitting at about 6.7%. So still quite high for some of those consumers that are in the real estate market to feel excited about potentially getting a new home.
By the way, how kind of you to assume I might be a DIYer. I think the most I've done is like hang a picture. I don't think that counts.
I'm learning to turn, change a knob or two in the house.
A knob. Okay, Nora. Hey, that's big stuff.
Advanced.
That's big stuff. Okay, so that's the DIYers in the picture. Walmart, we're going to get them reporting results tomorrow. The behemoth, how are expectations for them?
Well, that's going to be super important to continue to watch, especially if we think about the fact that Walmart is one of the biggest employers here in the United States, but it's also catering toward that shopper that's looking for affordability. Walmart, of course, is very, very focused on how they can discount prices and actually continue to keep the U.S. consumer shopping when it comes to grocery, apparel, and honestly, you name it. I miss Walmart back in Virginia. Don't really have one here in New York City, but that's essentially going to be a bellwether when we think about retail earnings more broadly that are still coming out.
Nora, thank you very much. Looking forward to catching up later in the show. That's Bloomberg's Nora Melinda, and we're going to have more on retail earnings in the next hour. Joe Feldman of the Telsey Group will be joining us. Now to a potential breakthrough in the fight against skin cancer. Merck and Moderna said their personalized cancer vaccines help cut the reoccurrence of melanoma in a large late-stage trial. Bloomberg's Madison Moeller covers the sector and joins us. I don't know where to start, Madison, whether it's the breakthrough or just the huge move in Moderna shares this morning. This is a really big reaction to the study.
Totally. I mean, we're winning sort of on multiple fronts here, and I think that that's the takeaway. I mean, this is, at the risk of sounding like a total nerd, a really big and important moment in science. This is something that scientists have been chasing for almost a century, is a personalized cancer treatment, personalized cancer vaccine. And so we're seeing an mRNA cancer vaccine really succeed in the first large late-stage trial, like you said. So a win for cancer, a win for the companies. For Moderna, which is still trying to find its footing really after the pandemic, we're seeing investors look at this and say, okay, maybe this company really does have a future beyond COVID, and potentially another really steady and big source of revenue if this vaccine does come to market as the companies expect next year. Obviously, that's still pending regulatory approval, but it's a pretty big moment both in science and for these companies.
Right, and as you and the team have been reporting, melanoma is the most deadly form of skin cancer, so this would be huge. But Are you also suggesting that a win here isn't just a win against skin cancer, that it proves something about mRNA vaccines, that they could be applied to cancers more broadly?
Exactly. So that's what the companies still really need to figure out. They're testing these vaccines in other types of cancer right now. And so we'll see if those results translate into other forms of tumors. But that's the hope, is that these mRNA is an incredibly flexible technology. That's why it worked so well for COVID. You can plug in these different mutations and sort of adapt the vaccine to the different COVID mutations. Similar theory, sort of strategy for cancer, which these tumors also have mutations. And what these scientists do is they take a biopsy of the people's tumors, and then they can customize these vaccines to match the mutations that are most likely to have an immune response. And it takes just 6 weeks, which is also pretty crazy.
I don't know if there's a good answer to this, but also when I saw this news, I thought, how many people won't take this shot? Just because of the huge anti-vax movement that's happening right now, that people would avoid something that could potentially stop cancer from coming back because it comes in the form of this vaccine.
That's 100% right. And it's something that is really going to be a consideration. And there is so much misinformation out there right now about mRNA. There's a lot of fear around these shots still. But when it comes to something like cancer that is potentially so deadly, people will have to hopefully talk to their doctors and make that risk-benefit analysis for themselves. But it's an important consideration that there's so much hesitancy and fear around vaccines.
Yeah, even
right
so,
now.
just such an exciting story. Thank you so much for bringing us that. That's Madison Muller from our healthcare team. Now, as I mentioned at the top of the show, the U.S. Treasury announced that it's ramping up buybacks of long-dated government debt after yields hit the highest level in years. Let's discuss with Bloomberg macro strategist Michael Ball. We'll get to maybe the motivations behind this in a second, but first, can you just chart with us the market reaction and why we're seeing such a steep one of yields down, stocks up?
Yeah, boom. I mean, this is kind of what we needed. This is starting to get a real front story driver of almost cross-asset price action for the last few sessions. We saw kind of risk yesterday take a little bit of a pause. Momentum finally died in the equity market. And it was all because, again, although sort of real rates have been methodical and linear, they've been creeping higher and higher, and people are sniffing out like pain and thresholds where we will start to have actually risk assets and risk appetite come off because we finally have a high enough real rate story going on in the back end. And again, the worry was we're going to not make it to Jackson Hole, where we would need clarity from Warsh on his reaction function and some further sort of guidance on how he's thinking about what tools to use in fighting inflation. Instead, now here, the Treasury's thrown him a lifeline in a lot of ways. Although the buyback size is relatively small, it's a strong signaling effect, and that's what the markets are gravitating towards, and that's why all of a sudden it's back to being a little more risk on. And of course, the most popular trade right now was sort of a steepener, so you're seeing a massive squeeze now, as guys really were expecting to hold this a little bit longer into Jackson Hole.
Of course, the irony, as many people pointed out this morning, is that Scott Bessent criticized his predecessor, Janet Yellen, quite frequently on using debt management as sort of like a quasi-monetary policy tool. Of course, what she did was different. It was issuing on the short end of the curve, which the Treasury is still doing. But do you look at this announcement, Michael, and say, maybe this is QE in disguise?
Yeah, I think that's sort of the puns. You saw the zero hedges of the world already come out with that, and exactly right. I mean, it's interesting, too, right as the Fed was sort of reducing the reserve management purchases, here we go with another sort of instrument to support Treasury liquidity as it's officially kind of set out, but it also is purchases. So, yes, to your point, it kind of is. Obviously, it's not the same as a larger scale QE program, but it buys time again, and it kind of calms the markets. Now, long end rate vol had been sort of drifting higher. It spiked post-July FOMC, kind of settled back down. The worry I was getting from a lot of traders was this wasn't like a capitulation move. This was an acceptance that yields should be higher, and that will eventually have real effects on the economy and obviously on financial assets because it, tightens financial conditions.
You say that this calms things for now. What does the longer-term trajectory look like? Because this doesn't solve the problem of the AI debt spending boom and just how much this government is spending and taking.
Yeah, so
debt.
actually was funny enough digging into all this before this headline broke this morning and was trying to get sort of the drivers because, we've had Mark Cabana on from B of A and he's really been hammering it hard. He was on this morning again and he did a good job. He was on yesterday and did a great job. And noting that growth expectations have actually kind of stagnated. They haven't gone up. We all know about the supply story. So the real driver over the last couple of weeks has been post-July FOMC uncertainty over sort of the Fed. So all these other variables are certainly in there, and they're certainly driving higher real rates. But the only change really has been the Fed's reaction function, the fact that the market's looking for more clarity there. And that uncertainty is causing greater volatility, albeit manageable still, mostly in the long end, and that's obviously meaning a higher term premium and a higher, basically, risk premium.
We are going to get an auction today, 1 p.m. 20-year bonds will be sold $16 billion of worth, kind of like the orphaned, unloved note anyway. Does it change anything for that? Or is it just like 20 years? Don't look here, it doesn't matter.
It's hit or miss. I mean, we're going to be going into it, significant rally now. So that may mean there needs to be some concessions. But yeah, that's kind of a unique animal that has its own unique demand dynamics. What has been interesting, I think we got the tick data more recently showing that like foreign buying has been changing, where the official counts have been stepping back. That doesn't necessarily mean anything for the 20-year, but it is interesting that the long end is seeing less official demand, although some of the private buying has gone sort of parallel, because the dynamics, though, are not as great for the hedging front.
Hey, Michael, great to catch up with you. Great to get your thoughts this morning on that breaking news. That's Bloomberg's Michael Ball. And let's get a check on your markets this morning. The S&P, again, it is now rallying up 0.4% after clocking 3 consecutive days of losses. Mirror image on the NASDAQ 100, also up 0.4%. Perhaps we are sacrificing the dollar in order to get the yields down. The dollar now down by 0.5%. Brent crude still above $91 a barrel. And let's just take a quick look at the curve, because as Michael was laying out, it is relief this morning. We're down by as much as 8.6 basis points on your 30-year yield. That is now below 520. Coming up on the show, President Trump hits pause on Canada tariffs as a tentative deal takes shape. This is Open Interest. Let's get you some high interest stories. A look at what's making headlines around the world. Long-dated treasuries are rallying after the Treasury Department said it will at least double buybacks in the sector. The move is aimed at improving liquidity, they say, after 30-year yields recently reached their highest level since 2007. The Treasury cited strong demand from market participants for expanded operations, but of course there has been some criticism lobbed at them that perhaps this is just QE in disguise. The UAE is cutting economic ties with Iran after accusing Tehran of firing ballistic missiles at its territory. Iran is denying responsibility. The move adds pressure on Tehran after peace talks stalled, and traffic through the Strait of Hormuz remains well below pre-war levels. And President Trump is delaying 50% tariffs on billions of dollars of Canadian goods for 3 days, saying the U.S. and Canada are close to a trade deal. The White House says that Canada has agreed to address barriers on U.S. autos, dairy, and alcohol. But Prime Minister Mark Carney says important work remains. The pause came less than 2 hours before the tariffs were set to take effect. Let's get more on this. Joining us now from Washington is Bloomberg Washington correspondent Tyler Kendall. Tyler, do we have any details on what this pause and what the agreements might look like, and if an agreement is actually even close?
Well, Dani, as you're outlining, we still have a lot of big questions here, considering that the White House came out and said that the two sides reached a deal, but Canada wasn't so definitive. Canadian Prime Minister Mark Carney falling short of saying that they had this deal done. We did get this document from the White House, which outlined that Canada is willing to take steps in regard to some of these issues where the U.S. has really been highlighting, whether that be alcohol or investment laws in Canada related to auto production. The USTR did tell us that the agreement will include, quote, comprehensive market access for U.S. goods, economic security commitments, and what they're calling digital trade alignment, but we haven't really gotten details beyond that. Keep in mind the context here is that President Trump was about to lobby these 50% tariffs under Section 338. This is a tariff authority that has never been used before, but does give the president the power to issue levies if the U.S. believes that U.S. commerce is being discriminated against. But importantly, the real crux of the trade issues between the U.S. and Canada right now have to do with those auto tariffs and those lumber tariffs, not under Section 338, but under Section 232. Those are those national security concerns that the administration has really tried to pile on in a bid to boost domestic production and protect our own markets. So the fact that we didn't really get movement on that does leave questions on where this is going to go. Even with all these questions, though, Dani, it is considered to be a relatively positive step, considering the tensions between the two countries have really been ratcheting up. And we saw the U.S. fail to renew the USMCA agreement. We are expecting years of negotiations, but maybe this could be some sort of sign that they are making progress on a broader deal.
Tyler, meanwhile, domestically, we are getting first reads on how the electorate is feeling. Yesterday, we spoke about the importance of the Florida primaries. We have the results of those in hand. What did we learn?
So there's a few different races that we can pull on here, Dani. If we start with the U.S. Senate race in Florida, that was Angie Nixon. I can't even understate how surprising, perhaps I think it's fair to say, her win was. She was up against somebody considered to have national name recognition. That was Alexander Vindman, known for testifying during the impeachment proceedings against President Trump. But if we look at sheer numbers, Vindman spent $9 million by the end of July compared to Nixon's $900,000. And it will no doubt bolster progressive momentum, but it does also likely weaken Democrats' chance to flip this seat. It is currently being held by Senator Ashley Moody. She was appointed to fill the gap left once Marco Rubio became the Secretary of State. So there's going to be a dynamic to watch there, whether or not progressive momentum can actually translate into wins for the Democratic Party come the general and the electability question. Very quickly, on the other side, the race that we were watching was, of course, the gubernatorial primary. Byron Donalds did end up clinching that. We spoke about this yesterday. He was considered to be the relatively more moderate candidate facing off some more far-right challengers that wanted this nomination. Dani, he is emerging with a massive war chest, more than $100 million. He has some big backers behind him, both in the political space, President Trump, but also names like Ken Griffin.
Tyler, thank you very much for your reporting this morning and every morning. Bloomberg's Tyler Kendall, live from the White House. Coming up on the show, we're going to catch up with Bloomberg Tech's Ed Ludlow on SK Hynix's share buyback and the growing backlash over data centers. This is Bloomberg. SK Hynix shares higher this morning after announcing a nearly $30 billion share buyback. Shares up 5%. Let's bring in Bloomberg Tech host Ed Ludlow. Ed, what do we make of the size and the timing of this announcement?
Yeah, it's a shareholder return policy to stabilize the stock, right? So SK's Korean shares are up 150% year to date. They rose 275% last year, but they are down significantly since the highs of June, where everyone was so fixated on high bandwidth memory. SK has a 60% market share for high bandwidth memory chips that go into data center. But what's really interesting about the mechanism of the buyback is that SK then cancels those shares instead of holding them under treasury stock. And if you remember, when SK did its listing of ADRs, they had issued new stock diluting shareholders, which was a particular grievance of the retail shareholder. So they're kind of unwinding that by doing this buyback then cancel, but also saying with everything that's going on in the world of AI and all of their capital commitments in Korea and here in the United States, they're committed to doing 50% of cash flows as returns to shareholders, which, you know, again, stabilization of the stock.
Yeah, stabilization, that helped this morning. The Treasury clearly stabilizing things too. Ed, elsewhere, sure. I wonder how much of this story is starting to register among investors, and that is this political pushback ahead of the midterms that we're seeing on data centers. Josh Shapiro of Pennsylvania becoming the latest to restrict data center development.
Yes.
We're working through, again, all of these local races at the moment. How much is that weighing on these companies' plans? Because they've committed a lot of capital to doing just that, building data centers in the U.S.
Yeah, American citizens' view of data centers is an issue for this midterm cycle. There is a very important feature on the Bloomberg today from the team that looks at the data on how that's manifested so far this year. So in the first 3 months of the year, $130 billion worth of projects, about 75 data center projects, were blocked in just the first 3 months of the year by varying local initiatives who are pushing back against their impact on communities. That 3-month tally is the same as all of the projects that were disrupted in full year 25. And it's completely bipartisan. It's not unique to Democratic states or Republican states. It is pretty much across the board. There are certainly some areas of focus within that. Michigan and Georgia account for many projects that right now are facing local opposition. And you know, I would just go out and read like the full spectrum of reporting that's on the Bloomberg. There are even races at the gubernatorial level, for example, in Florida, where competing sides of the data center NIMBY debate are both backing the same candidate. You know, it shows you the bipartisan nature of this issue.
Thank you so much. Great to see you this morning. Looking forward, as always, to Bloomberg Tech, 11 a.m. Eastern. That's Bloomberg Tech host Ed Ludlow. Let's continue this conversation and bring in UBS Global Wealth Head of Global Equity Strategy, Nadia Lovell. Nadia, great to see you. I wonder, we talk a lot about midterm risk, and I wonder how much of that should now concentrate on the risk to these hyperscalers and any of these big data center build-out projects. If, to Ed's point, what's emerging is a bipartisan NIMBYism to say we do not want data centers in our state.
Yeah, you know, it's something that we have been watching very closely at UBS and actually has published on this. And while we think that this is becoming getting more traction, it could delay some projects, and we are seeing delay in projects, but we don't think that it derails the sort of story. We do think that a lot of these states will come to some sort of an agreement, whether it be pay your own power, right? I think that's a big issue. Also water, responsible use of water, higher and local, and all of that stuff. So I do think that the hyperscalers will emerge in some sort of an agreement with the various states, because reality is America needs to keep up in this arms race to build data centers, to continue to deploy AI. And so this can eventually become more of a national issue and less of so localized.
That's where I wanted to go, because I did have a conversation with Brookfield that one of their latest data center announcements was on federal land. And I asked them, that surely can't be a coincidence that you're looking to federal land where states can't block it. But in the race for this, how important is it to the U.S. government, considering we're not just trying to support these tech companies, but we're also competing against China, which can freely build wherever they want a data center?
And we know that one of the advantages that China has right now is really energy, right? And, you know, cheaper energy. And so I do think that that's part of the story, and that's why we don't think that this gets derailed, that there will be some sort of a negotiation around that. And do think that eventually there will be government support, then there is government support from the current administration around building out data centers and around our race in AI. And so I would expect that to continue. But yes, you're going to see some pockets around this, particularly around every election cycle has its issues, right? And this seems to be the one as we head into midterms and probably even into 2028 and the presidential cycle.
All right, Nadia, stick with us. We have to get through the opening bell. Nadia Lovell. A quick check on your markets ahead of that opening bell. Just a few minutes to play for, and we are looking at higher equities as yields come in by now nearly 6 basis points on your 10-year yield. On the other side of this break, we'll have your opening bell. Let's get this trading day started. Moments away from the bell, this is Bloomberg Open Interest. I'm Dani Burger. Stocks snapping 3 consecutive days of losses, the first time we've done that in about a month's time, thanks to a rally we're seeing in treasuries after the Treasury stepped in with increased buybacks as much as double on the long end. S&P futures up 0.4, as is the NASDAQ. Dow Jones also playing around the same level. Ringing the opening bells today, we have Russell Investments, the ETF provider, down at the New York Stock Exchange. You can see one of their listed funds, BD, is up there. They also have New York Stock Exchange Texas. I wonder if they're listing in their Texas exchange, too. I know Texas has been a big push for the New York Stock Exchange and all exchanges. We're going to be down in Dallas later in the fall, by the way, for Bloomberg Invest, so come listen along with us. The NASDAQ, you have Tribeca Strategic Acquisition Corp. You can probably guess what that is. That is a SPAC they're listing. I think they're looking for a tech-related company as a target. I also want to show you what some of these earnings are doing pre-market. So we heard from Target, Lowe's, TJX. The story with Target, yes, they've been on this rebound course. However, guidance fell short of what investors were hoping for. They wanted a bigger beat. Shares are up something like 50+% this year. Lowe's actually now positive. It was lower in the pre-market after their earnings suggested that there is some weakness tied, as you guessed, the sluggish housing market. That impacts them. TJX falling 5%. Yes, sales beat estimates, and it announced plans to expand its global footprint, but maybe we also expected more there too. Just want to point out Moderna, this huge gain in early minutes after the bell opened, up more than 80%. Its study found that its vaccine, combined with Merck's Keytruda, help reduce the risk of melanoma returning. A really big result from them that also suggests that they can do well with other cancer-related treatments. Elsewhere, we have to show you this move. It is another day where the bond market is dictating how the overall market feels. The Treasury announced that it's ramping up buybacks of long-dated government debt after yields hit the highest levels in years since 2007 for the 30-year yield. We're down now by 8 basis points. Let's bring back UBS Global Wealth Head of Global Equity Strategy, Nadia Lovell. And Nadia, the immediate reaction to this announcement was yields move down and stocks move higher. How sustainable do you think that move is when the Treasury is coming in and increasing their buybacks?
The recent pressure that we've seen in equity, some of it has been attributed to the move on the long end of the curve. And you also think about the Treasury over the last just few weeks and it's stepping in to support Treasury markets in the fact that you had President stepped in several weeks ago to support the yen, right, in order to keep the longer end of the curve yields low. When you look at it historically, equities care why yields are moving, why bond yields are moving. And historically, while there isn't a magic level as to when equity starts to wobble around that, it has tended to get a little bit nervous around that psychological level of 5% or so on the 10-year. So we don't expect the 10-year to get to 5% in any sort of sustainable way. We expect yields to start to come back in on the 10-year. We're looking for about 4.25% by the end of the year and 4% by the time we get to mid of next year. And I think what matters for equity is the earnings environment, which has been quite strong. While bond yields can create some volatility in equities, I think the sustainability of this bull market is more dependent on the earnings growth, and we feel very good about that.
Right, so 30% earnings growth, but does that mean when we get past this earnings season, there's kind of a lull in news that the bond market does become more of a bully to how equities behave?
Well, I think short term, like you could see some volatility, particularly as we head into Jackson Hole, particularly as we head into the next FOMC meeting. But remember, we also have a big earnings next week, NVIDIA earnings coming up. So it's not that we are completely in this earnings vacuum. So we will get some incremental data points around that. And so while we think that there could be some temporary volatility, as you look into, the end of the third quarter into the fourth quarter, we're seeing upward earnings revisions coming out of this earnings season. Typically, you will start to see analysts trim estimates, but we're actually seeing estimates move higher. And so that gives us a conviction that the momentum in the earnings story will continue into year end. And despite temporary volatility, we would be buyers of any dips that are related to, bond market volatility that's being caused in the equity markets, because we do think that the earnings growth, at least into the year end in the first half of next year, is sustainable.
Though the chip stocks did sell off quite a bit as yields move higher yesterday, and I wonder for them, if they're becoming increasingly tied to macro trends, tied to the bond market versus like idiosyncratic growth of chips, the question kind of leaning towards, okay, are all the good earnings priced in? So now the way that we move is maybe what the bond market is telling us.
It's several reasons why, you've seen some volatility in the semi space. It's not just the bond yields, but it's also, yes, the debt issuance concerns that are happening as you see more hyperscalers issue debt. You're also seeing some, company-specific data points over the last couple of days around run rates for AI monetization and cloud growth and so forth. So there are numerous things happening. And the fact is that you've had semiconductors that have run a lot this year, so there's some profit taken happening. So we wouldn't put that squarely that all the pullback that you're seeing in chips has to do with what's happening in the bond market. We think it's more what's happening in terms of the hyperscalers and the monetization story, that's more important than the bond market, because clearly, like, hyperscalers are able to continue to fund this capex, whether it's through cash flow from operation or tap in the capital markets, which they had no problems doing.
Right.
And diversifying that beyond the U.S. Debt market and into all the way to Australia. So there is no shortage of capital for this capex build out. So we're less concerned about that. And it's more about what does monetization look like? What does return on invested capital looks like? I think that's what the market cares more about in the AI trade than they do a bond market. The fact that, bond yields are moving up, I don't think that that's going to derail whether, you'll have Google go out and pay 7%.
So this might have the same exact answer, but what about supply? What about as we get more IPOs coming on market? Does that change things?
Yes, there's expectations for more, some of these, startup companies that are not really small in terms of startup. They're quite large coming to market this later this year. I think what the market wants to see is the financials around this. Like, again, what is the monetization plan looks like, and how fast is that happening? Because that would tell us, the demand story and how how sustainable this is. I do think that we have some conviction in it because when you look at the backlog of some of these hyperscalers, regardless of what's coming to market in terms of equity issuance, when you look at the backlog for the hyperscalers, the fact that you have backlogs for the largest hyperscalers at $2.4 trillion tells you that there's a long runway in terms of earnings visibility, despite the fact that you might have more equity issuance coming to market. So I think that the core story is still quite intact, at least over the next few years, around AI, the build out, the capex, and the demand, and the fact that we think that demand will continue to outstrip supply. I think Amazon sort of hinted at that during the earnings season as well.
Yeah. So we were having this conversation with J.P. Morgan's Gabriela Santos yesterday. Basically, everything is so tied to AI now because you also have companies, we hear from Walmart tomorrow, for example, a consumer company, but has been broadly adopting AI strategies. When you look through the portfolio, where do you find true diversification? Like something that does not touch AI, that can behave differently than the rest of the market?
I think that's a great question because, our Chief Investment Officer of Americas, Ulrika Hoffman-Bouchardy, actually put out Signal Over Noise on this exact same topic on Monday, talking about that the fact is that there's so many things that you think are diverse, add diversification to your portfolio, but actually doesn't because AI compute demand is so linked to so many things now, whether it's utilities, industrials, financials, or, tech, and even in the bond market. So you have to be mindful of that. I think what you're seeing in terms of reverse, look at healthcare, right? This is a sector that we have had an attractive rating on for much of the year, and it's finally starting to perform because it does offer that diversification. You see on days where tech and AI is trading off, that healthcare, in the last 3 months, a top performing sector, it's healthcare. Right? And, you're seeing the news this morning on an innovation that's happening. We think that story will continue, whether it's in GLP-1s, diabetes and obesity, and also now cancer treatment. And you're seeing some alleviation in the pressure in the managed care space that was under pressure earlier this year due to concerns about reimbursement costs and also utilization and medical cost ratios. That's also, so you're finally seeing a resumption of earnings growth within healthcare, and valuation is not extended. So I think that's a nice diversifier to the overall portfolio that isn't tied to AI capex story. Ultimately, we think that it will be a part of the AI monetization story, but that's, several years down the line.
Always so great to have you on, Nadia. Always a masterclass. Thank you so much for joining us. Nadia Lovell of UBS Global Wealth. Let's get a check on your market about 10 minutes into your trading day, and we're still higher. Part of that is thanks to treasuries, but this market, as Nadia was saying, is moving on more than just that. Earnings look strong. We're up about a third of 1%. Healthcare, again, Nadia spot on. Exactly what she was saying is why the market is moving today. We're having these huge innovations coming from these healthcare companies. Eli Lilly is doing well, but the real standouts are Moderna and Merck. Moderna, well, the two of them together forming a treatment, an mRNA vaccine from Moderna combined with one of Merck's Keytruda treatments that helps halt the reoccurrence of melanoma, a huge advance. We're also seeing some other earnings in the winners column. Home Depot is there after we heard from Lowe's. In the losers column, it is a lot of the tech stocks that are selling off: Broadcom, AMD, Intel, Lam Research. Some financials not doing well either. I want to give you another look at how the 30-year yield is behaving after that announcement. Again, the Treasury announcing that they will at least double buybacks for the long end of the curve, $4 billion. Look at this drop that we have seen today. We are currently on this 10-year yield trading at 30-year yield rather, at 520. The close yesterday, you can see it here, was around 530. 530 was the high that we closed earlier this week, which was the highest level since 2007. The timing here, perhaps not a mistake. Scott Bessent's Treasury Department coming in and announcing an increase of buybacks. 30-year yields plunge as the price itself rallies. Coming up, we're going to talk more about that pharma news. Bloomberg Intelligence senior pharma analyst Sam Fazeli reacts to the Merck and Moderna landmark melanoma vaccine study. That's up next. This is Bloomberg. So I just pointed out on the move screen on the Bloomberg moments ago that Broadcom, Alphabet, AMD, Intel, a lot of these AI stocks are falling. Just want to point out that viewer Brian Quartarolo points out that this is likely because of the Anthropic IPO. If banks are getting ready with this issue, the AI trades suffer because people need to take profits in order to accommodate some of that. So thank you. We always love viewer comments. Please write in with all of your theses on market moves. Let's get some other moves and get your top calls. We teased her before. Here she is. It's Nora Melinda. Nora, what are you looking at?
Hey, Dani, 3 upgrades for you this morning. First up, let's look at Honeywell Aerospace, getting some love from Morgan Stanley. The firm upgrading the stock after a 27% drop since its spinoff, saying investors may be punishing it a little bit too much. Morgan Stanley says the customers are there, but the challenge is getting enough product out the door. You're seeing shares of Honeywell up by about 2.5%. Next up, over to retail, Jefferies upgrading the Dollar Tree to hold, saying shoppers are starting to come back. And while Target's still a threat, the firm likes what Dollar Tree is doing with its prices as well as its customer traffic. Shares up by about 2.7%. And finally, Dani, remember what it felt like all of our lives were spent on Zoom at one point? Well, Bank of America is taking on coverage of the company with a new buy rating, saying Zoom is becoming more than just video calls and a bigger part of how we communicate at work. We'll get a fresh look at the company when it reports earnings next week, but as for now, shares up by about 2.5%. Those are your top calls. Dani?
Nora, thank you very much. Now let's get through to the huge news coming from Moderna, a potential breakthrough in the fight against skin cancer. Merck and Moderna said that their personalized vaccine helped cut the reoccurrence of melanoma in a large late-stage trial. Let's get to Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli. Sam, I say huge news because the market reaction has been huge. So in the pharmaceutical world, is this a really big breakthrough?
Oh, hi, Dani. I think the best share price to look at is Merck, because that's where you're getting no, let's say, dilution of the or involvement of short covering that's probably going on in the Moderna share price move at the open. So that's giving us a 6, 7%, 9% rise, right? This is huge for Merck, depending on the data. Remember, the press release only says that they succeeded at this interim level. So it is a groundbreaking thing. It's a cancer vaccine, although they call it individualized neotherapy, neoantigen therapy. It's a vaccine, essentially, and it's one of the first to be showing in this kind of big indication using mRNA that you might be able to do this, which I think, therefore, there's a lot coming in here also for hopes for other indications, Dani.
Is there a risk, though, Sam, with the political climate, especially where I am in the United States and sort of the growing anti-vax movement, that it's as successful as this is, maybe the uptake rate will be limited because of that?
Yeah, I don't think so. I don't think that cancer has the same issues as infectious diseases or COVID or flu would have. And so, to be honest with you, if this is the good data in terms of the groups of patients that are responding, in terms of the magnitude of the benefit, and let's not forget, Merck has called this clinically meaningful, not just statistically significant, clinically meaningful. When pharma companies say that, it usually means that they're seeing a meaningful, significant benefit. Not just a statistical 20% reduction. So we're now, I think, setting up for a 35% reduction in the risk of recurrence of disease in these patients. So that would be a good win for patients for sure, and quite clearly for the share prices.
Sam, thank you so much for joining us. A really fascinating story. Sam Fazeli from Bloomberg Intelligence. Coming up, Treasury Secretary Scott Bessent stepping in as long-term yields hit decade highs. We're now down by more than 8 basis points on your 30-year yield as it forces gold to rally and the dollar to come in. That's next. This is Bloomberg. A big story driving markets this morning. The Treasury announcing that it will at least double the size of its liquidity support for buybacks in longer-dated treasuries. Let's bring in Bloomberg Intelligence U.S. rate strategist Ira Jersey. Ira, the Treasury says it's stepping in to support liquidity, but should we also read this as the Treasury putting a ceiling on long-term yields?
Well, I think they would certainly like to see long-term yields come down a little bit, and certainly they have, at least for now. You know, this is a little bit like maybe the beginning of a larger coordinated effort between, issuance or buybacks and other things to try to arrest the sell-off that we've seen in the long end of the yield curve. One of the problems, though, that the Treasury is going to have is this doesn't do anything for the deficit. It doesn't improve the deficit at all, so there's still going to be a lot of issuance. It's just a matter about where along the curve it's going to be.
I guess the question is, if that doesn't help then, and we continue to see yields drift higher after this, Ira, is the next logical step outright cutting long-term issuance?
Yeah, and we actually wouldn't be surprised if they actually cut 20-year issuance in particular a little bit. It's kind of a sector that is very unloved, and I don't think it's been performing the way that some on the Treasury Borrowing Advisory Committee and others at Treasury had hoped. So it wouldn't surprise us at all if they cut the 20-year a little bit. There's still decent demand at the long end. You know, you look at the auctions, and we do have another auction today, so that'll be interesting to see how that goes in the 20-year. But last week's 30-year auction went fine. And you know, yes, at much higher yields. But keep in mind, like, issuance is only part of the story here. We have to remember that a big reason why you have much higher yields is everything from Fed credibility to yields globally going up. So, you know, a lot of the moves overnight, for example, were being led by Japan, not being led by treasuries. So this isn't just a U.S. story. It is a global story and a global phenomenon.
Right. I guess on the other side of things for the Treasury, what would be the justification right now, Ira, if you see any, of needing to support this market in the form of increased liquidity?
Yeah, liquidity, quite frankly, has been okay. When you look at things like bid offers, I think that they call these liquidity operations, and it is a little bit more like I was mentioning, an Operation Twist. And the Treasury Department does have precedent for this. It's been 60 years since they did the original Operation Twist, but nonetheless, you know, they're issuing more short-term debt. They're now going to be buying back some longer-term debt. But to your point, like at the next refunding announcement in November, it's very possible that they incrementally change the amount of issuance at the long end in order to try to keep long end interest rates a little bit lower than they have been more recently. But you know, the best thing that the government could do is try to you know, basically reduce the deficit. But you know, they've tried that, right? That was the whole thing that Elon Musk was trying to do, and it just hasn't worked because so much of it is structural that you're going to wind up needing to actually increase issuance at some point in 2027 in order to keep up with both the deficit and then all the maturing debt that is really starting to ramp up actually kind of now.
There's some interesting points of tension that this sets us up for. One, which has been commented on already, this idea that Treasury Secretary Scott Bessent had criticized his predecessor, Janet Yellen, for intervening in the debt markets in a way that seemed like stealth QE. The other one, Ira, that I'm more interested in exploring is how this sets us up with this Fed, with a Fed governor who, for one, wants markets to be independent of monetary policy moves, and now it's a market that is moving based on Treasury moves, and two, a Fed governor who has said that in large part, it seemed like part of his hold was because bond yields were going higher and doing some of the work for him. How does this complicate things to have the Treasury stepping in and to a large degree, at least in the short term, dictating market moves?
Well, we always forget there's actually in the Federal Reserve Act, there's this really awkward statement that the Fed's been contending with for the last 113 years, and that is that they're supposed to maintain moderate longer-term interest rates, but they don't. But the Congress hasn't defined what moderate means, when you look at where yields are now, Kevin Warsh has to be saying to himself, okay, how might I keep moderate longer-term interest rates, and how do I do that? And one of the ways to potentially get long-term interest rates down, ironically, is by raising short-term interest rates to get inflation expectations down, maybe growth expectations down a little bit, and all of that might help the long end of the yield curve. Now, he's probably not going to do that. I think that Kevin Warsh, that Chair Warsh, would like to maintain interest rates where they are, even lower them over time. But there is certainly a case to be made that if your ultimate goal is to get long-term interest rates down, short-term interest rates maybe need to go up, at least temporarily. So
just quickly here, Ira, only about 30 seconds. Does this impact how Kevin Warsh is thinking, or what the Fed does from here to have this movement in long-term yields?
Yeah, I don't think very much. You're talking about 8 basis points. We've sold off 40-ish basis points in 10s and 30s over the last 2 months. So I think that a little bit of this is retracement, and the move itself, when you take it in the big picture, it's only about 2 days of what's been priced in terms of daily movements.
Ira, wonderful to have you on. Thank you for joining us. Ira Jersey from our Bloomberg Intelligence team. Coming up, we're going to continue this conversation. Kathy Bostjancic will be joining us, plus Betterment CEO on insights into Gen Z's long-term investment strategy. Hint, it has to do with sports betting. And the CEO of TrueCar discusses looming auto tariffs as Trump puts the brakes on with Canada for 3 days. 30 minutes into your trading day, the bond market rally continues. Welcome to Bloomberg Open Interest. I'm Dani Burger. Stock snapped 3 days of consecutive losses. Coming up on that Treasury announcement, Scott Bessent surprises markets by boosting debt buybacks after yields hit multi-year highs. Target and Lowe's add to a mixed bag of retail results, with Walmart still to come tomorrow. And President Trump hits pause on Canada tariffs as a tentative deal takes shape. We begin with our top story: the Treasury stepping up buybacks of longer-dated government debt after yields reach multi-decade highs. Let's get the details now from Bloomberg's international economics and policy correspondent Michael McKee in Washington. Mike, what are the details?
Well, the details are that Treasury is going to double the size of buybacks to $4 billion from $2 billion starting this next month. But the issue there is it's not so much that's going to have a huge effect as it is signaling Treasury is worried about where we might be going in the markets. You look at the reaction today in the yield curve, and it is fairly dramatic, even if, as Ira Jersey pointed out with you a few minutes ago, it's more of a retracement than a significant move. But it does show that the market is sensitive to what Treasury is doing because Treasury is trying to send them a message. Their problem at Treasury is we've got inflation uncertainty, we've got bond market volatility, both because we have issues with inflation and because the markets are getting worried about the long-term debt and who's going to absorb it all. Higher term premiums is the result. The Treasury, therefore, is moving down on the curve, talking about more bill issuance, getting out of the longer term on the run issues, at least scaling it down. And that means that there's less liquidity at that end of the curve. And so here they're hoping that by buying back more bonds, they can increase liquidity in the markets. This chart shows the long-term problem for Treasury, though. The debt is rising by so much, and Republicans are still pushing for a much bigger debt in the next fiscal year. The two lines there show what they're paying and also how much additional they have to pay to the Treasury to cover the interest for the national debt. And that's getting to be a real problem as interest rates rise. So it's kind of an effort by the Treasury to cap all of this. But I guess I'll go back to what Ira said. It's not clear how well this will work because it's a global problem and it doesn't solve the bottom line issues of where inflation's going because of the war or where the debt is going.
Mike, over a year ago, in April 2025, Anne-Marie sat down with Scott Bessent, and he had told her that we were a long way from needing to take action on treasuries, which maybe we've traversed that long way. But he also mentioned to her that they have a big toolkit. He mentioned buybacks. I wonder if this sets the stage, if they've deemed that this is the time to intervene, if there are other parts of that toolkit that we might need to look out for to be dusted off.
Well, probably the only thing Treasury could do is to change the auction sizes at longer ends, and that's been a consideration for a while because of this growing issue. But they have pledged in the most recent refunding statements that they would keep Treasury auction sizes unchanged for some quarters to come. Maybe this is a sign that's going to change. The other help could come from the Fed if they raise short-term interest rates and increase credibility in terms of inflation fighting. That could bring down long rates as well, but that would require the folks over at the Fed to raise interest rates, and we're not sure how Kevin Warsh would feel about that and the others, not just because of whether you want to raise rates to deal with inflation, but whether you want to partner with Treasury on this.
Mike, thank you very much for your coverage. That's Bloomberg's Michael McKee in Washington, D.C., also ahead of Fed Minutes. Let's bring in Nationwide Mutual Insurance Chief Economist Kathy Bostjancic. Kathy, I wonder what signal you're gleaning from the Treasury this morning as they announce they're stepping up their buybacks on the long end.
Well, hi, Dani. Well, it certainly is a signal. One, it's discomfort with long-term rates rising, just as Mike McKee laid out, and also liquidity issues, right? Buying off the run treasuries helps with some of the illiquidity and those issues. But I agree with Mike that the fundamental reasons that long-term rates went up are still there, right? And he enumerated that: fiscal concerns, inflation uncertainty about the Fed's reaction function, and also corporate bond issuance has been really picked up related to AI spending. So all of that's really pushing on the upside. So we may get some covering of those very crowded steepener trades that were in the market. But whether this persists long run, probably not. There's going to be upward pressure.
We were speaking with our in-house analyst, Ira Jersey, about tension with the Fed, with a Fed chair who wants markets to act independently without influence, at least from the Fed, and now a Treasury Secretary who is trying to influence bond markets with increasing buybacks on the long end. Kathy, how does that change things when you do have Chair Warsh saying that part of the reason they didn't need to hike in the last meeting was the fact that bond markets were tightening financial conditions for them?
Yeah, a bit ironic, to say the least. And I really will be looking towards the minutes to see if we get any clarity on that. As you said, Warsh spoke a lot in the press conference about how the markets were doing a lot of the work for the Fed. And does that come through in the minutes? How do they, edit that or massage that? Obviously, they don't change the content of the meeting, but they can certainly highlight or present things in the minutes that they want to. So I'll be curious to hear that. I also next week, how does Chairman Warsh talk about this and talk about the dynamics in the bond market and particularly long-term rates? And does he try to improve his communication style? Because that's probably played some role as well here.
There is an element, just looking at the market reaction to this. We have yields come in, stocks go up. Gold also getting a huge bid, but also caught in the pressure of all of this is a sell-off we're witnessing in the dollar at the moment. And Kathy, I wonder if there is a risk to see sustained dollar weakness, if this points to more intervention coming from the Treasury, and if there are economic impacts of an increasing weaker dollar at a time where we're still trying to keep a lid on inflation.
Yeah, good question. I think we're far away from the Treasury intervening on the dollar's behalf per se, right? We know they intervened on behalf of the yen for a little different angle at that. So I don't see that really an issue now, but certainly, if you see, interest rate differentials or interest rates moving lower, that could put some downward pressure on the dollar. And it really does matter what happens across the global asset flows too, right? What's happening in Japan or the UK, where yields are rising quite sharply compared to the Treasury. But I don't think at this point we'll have a real problem with the value of the U.S. dollar.
All of this does just set us up so interestingly for Jackson Hole for the symposium later next week, Kathy. I mean, what are you looking out for when we hear from the Fed chair? Because there's a lot for him to tackle, or probably, as he hopes to, not tackle at all.
Yeah, I think there's a lot more pressure on him to speak more, right? To share more. And we're not talking forward guidance, explicit forward guidance. I think most investors agree that that's not really what's needed at this point or warranted. But I think commenting on conditions, whether it's in the markets or the economy, describing the reaction function. We know what other Fed officials think, and I think we generally know what Chairman Warsh is thinking. But is he thinking that we have the right inflation measures, right? What are the task force what are they looking at? And I think that was a little confusing in the press conference too. It wasn't just if inflation's high, the Fed will raise rates. It's which inflation number should we use? Because he kind of put some doubt whether it should be the PCE or CPI number.
But when we do see the family fight that Kevin Warsh has talked about in the minutes today, Kathy, does it do anything to dilute the power of Chair Warsh, dilute his ability to change market perceptions if we see a real disagreement among FOMC members and ones that are being more outspoken than the chair at this moment?
Yeah, I think that is a risk, that the family fight kind of overwhelms, the chairman's view, and others kind of step into that void. So that may be, Jackson Hole may be another opportunity for him to kind of reevaluate that and kind of put his own message out there without forward guidance or explicit guarantees, but just give a sense of his view of how inflation dynamics are evolving, how is growth evolving. I think would be really helpful. And we'll see also what the minutes say about the family fight. It could be that even though we only had 3 dissenters, there were many more that were on board with raising rates, but they just held off. I do think they have some breathing room, though, with the recent data. So we're not looking for a rate hike, but certainly, how it's described in minutes will be interesting.
Kathy, so great to have you on. It's going to be really, really fascinating over the next couple of weeks. Nationwide Mutual Insurance Chief Economist Kathy Bostjancic. Let's get a check on your markets this morning. Getting a lift from the drop in Treasury yields as Treasuries rally after the Treasury announcement that they're at least doubling, they could do more on the long end of the curve of buybacks. We are now looking, though, at the NASDAQ falling down about 0.5%. Again, as one viewer writing in saying that we do have to digest an Anthropic IPO. We're getting this drip feed of news about various moves they're making, in order to gear themselves up for that. 10-year yields, those fall by 6 basis points. They're showing you earlier the 30-year yield falling by as much as 9 basis points as Brent crude moves higher alongside gold, but the dollar falls this morning. Let's look at some of the individual movers this morning. With that is Nora. Hey, Nora.
Hey, Dani. First up, Merck and Moderna are surging on what could be a major breakthrough in the fight against skin cancer. Their experimental vaccine cut the risk of melanoma returning, and just look at the stock reaction. Merck on track for its best day since 2009, and Moderna for its best day ever. Next up, it's been a rough 2 months for SK Hynix. Shares are down more than 50%, but now the company is planning a $29 billion buyback and may also pay a special dividend. You're seeing shares to the upside by about 0.3%. And finally, a comeback for Estee Lauder. The company ended 3 years of falling annual sales and raised its outlook. Shares are on pace for their best day in almost 15 years. The stock up about 16%. Those are your morning movers. Dani?
Nora, thank you very much. Coming up, we get back to earnings. Retail earnings give us a fresh read on the consumer. More coming up next. This is Open Interest. Get you some high interest stories. A look at what's making headlines around the world. The UAE is cutting all economic ties with Iran after accusing Tehran of firing ballistic missiles at its territory. Iran is denying responsibility. The move adds pressure on Tehran as peace talks remain stalled and traffic through the Strait of Hormuz remains well below pre-war levels. Hedge fund heavyweights Rocos Capital and Brevin Howard were among firms caught wrong-footed by July's AI-driven market volatility. Both lost 1.2% for the month. However, D.E. Shaw bucked the trend, posting gains despite the turmoil. And a major new financing deal is fueling the AI data center boom. Eagle Point Credit Management is providing about $1.3 billion in private credit to a Texas campus tied to Anthropic. The loan is part of a massive $16 billion financing package for the nearly 3,000-acre project, with Anthropic expected to be its primary tenant. And in earnings news, Target boosted its sales outlook as its recovery efforts gain ground. Lowe's cut its outlook, though, on a sluggish housing market. Both shares are up significantly higher this morning. Joining us now is Telsey Advisory Group Senior Managing Director and Assistant Director of Research. That is Joe Feldman. Joe, great to see you this morning. There were some questions as to how the market would receive these earnings, especially in the pre-market trade. Both of them decisively up. Let's just start with Target. What signals did you get from executives and the results this morning as this company tries to continue its turnaround effort?
Yeah, I think we got a strong signal that the turnaround is working, that their efforts to improve value, to improve the design element of the merchandising, and to have newness in the stores and better in-stock positions all seem to be helping. We definitely saw a very good second quarter on top of a very good first quarter. They raised their guidance for the full year. I know there was a big tariff refund in those numbers. Remove that tariff refund. They still beat on EPS. They still beat on sales and had a very good, really good quarter. So the transformation's working.
But with all of these companies, though, Target reporting a $1 billion in tariff refunds, how much of that is being put aside, or do you put aside, Joe, as kind of a one-term effect that doesn't necessarily factor in, or as part of the rally we're seeing the benefit of tariff refunds?
Yeah, no, I think people are kind of looking at the underlying health of the business, excluding the tariff refunds. These retailers deserve to get them. I mean, clearly they were impacted last year by having to pay those refunds. Now they're getting it back. So it's not like, I know it's one time, but it's different than a traditional one-time expense or benefit. This really is something that they did have to deal with last year, and they've gotten better at dealing with it. I think this strength in the market today reflects the fact that their sales were up 3.8% in terms of same-store sales, driven by traffic that was up 3.6%. So it was all traffic driven. People like what they're seeing at Target, and there's definitely been a comeback to the brand in the store.
When it comes to the operational improvements that they've been that you mentioned, Joe, snack sales growing by double digits in the second quarter. So they have things like protein, healthier items. How fickle, though, is this consumer? And what does that mean for someone like a Target that needs to keep up with the varying demand of what the consumer wants to eat, wear, and see at this moment?
Yeah, I do agree with your point that it's a little tougher than, say, like a Walmart that's a little bit more fashion basic oriented, whereas Target tries to be a little bit more fashion oriented at great prices. So it creates a little bit more pressure there. But they're doing a really sharp thing. You know, they've changed their approach on food. Think of Target trying to be more like Trader Joe's than just a traditional grocery store. So, having more select items, things that can still put dinner on the table, but being able to do that in a way where you have newness, innovation, some new flavors, different trends, and they're doing that across the store. So that, I think, is resonating. And most importantly, it's at value. I mean, they've invested a lot in price. They've invested a lot in wages for their employees to treat consumers and to treat the stores a little bit better.
To that point, if we compare it to Walmart, one of the benefits that Walmart has, if there is any sort of economic downturn, is they're less cyclical. They have more grocery exposure than a Target does. Do you think that the direction that Target moves here on out is trying to pick up more grocery, to try to be something like a Walmart when you're like 60% of your sales are coming from food stuff?
Yeah, I don't think Target is trying to become Walmart. I think importantly, they're trying to stay away from that and keep their mix the way they have it. I think they're trying to become Target again. The old, Target made a little more fashion quotient there that would get people excited to go to the store because you can get great items that are on trend, but at really value prices. And that's where they're making a difference. Walmart, I think, continues to dominate within grocery. They lead it with that. They're the lowest price operator out there. Every price check we've ever done, the grocery prices are best at Walmart. And you'll see that customer continuing to go there. Walmart's also done a very good job on their discretionary side of their business, where they've made some tweaks to improve it, increase the on-trend element a little bit, and that's worked. So I think there's room for both of these players. I worry more about the middle market players in other categories, like a Kohl's or other players like that could get hit and have been hit. They've been donating share, I think, to Walmart and Target and others.
Joe, also, I'm really interested in the Lowe's reaction that we've seen this morning. The initial read pre-market was a drop. This idea that the housing market is weak, Lowe's is more exposed to a DIYer than a Home Depot, less professional services, and yet we get this rally 4.5%. Well, what did you make of what we heard from Lowe's?
Yeah, I was a little surprised by that too, especially when you saw it in comparison to Home Depot yesterday, and Home Depot put up better sales trends. Now, what was interesting on the call with Lowe's, they pointed out that, Home Depot benefited from the tariff refunds a little bit earlier than Lowe's did. And they directly commented that they felt that Home Depot was aggressive with promotions. I don't know if they were overly aggressive with promotions. I don't know if that's a fair assessment of really Home Depot's strength and how well they did in the quarter. But there is the perception that with with Lowe's getting some of those tariff refunds to come in the future, and they should have some more of them in the second half. Those are not baked into the guidance. Theoretically, numbers should be a little bit better than what they're saying, but clearly they painted an arguably more cautious picture of the consumer than what Home Depot did yesterday.
Joe, can we just wrap this up? You mentioned a bit throughout, but I would love to just get your read. Set us up for Walmart. What are you expecting? What should we be looking out for?
Yeah, I think Walmart's going to have a good quarter. I mean, we're looking for, their same-store sales in the core Walmart U.S. business to be up 3.8%. I think that's around where the street is. There's concern among investors that Walmart sales have slowed this quarter, and then people always look at how strong Target was. It was much better. Maybe they're taking market share. I again think they both can kind of go after the market and win and take share from others. So we're still thinking Walmart's going to have pretty good results. I think they're going to be able to flow through to the bottom line and have a solid quarter. I don't know that we'll get an increase in guidance, probably just a maintenance of the guidance at this point. But we think that just kind of sticking the landing would be a good thing for Walmart and to get that stock moving again.
And we'll hear from them about 7 a.m. tomorrow before the opening bell. Joe, great to have you on. Thanks for joining us, Joe Feldman of Telsey. Still ahead, TrueCar CEO Scott Painter on looming auto tariffs as the U.S. and Canada say that they are nearing a trade deal. That conversation is coming up. This is Bloomberg Open Interest. Nearly an hour into your trading day, and stocks break 3 consecutive days of declines to go up 1/3%. NASDAQ still under pressure as a lot of the AI stocks resume their selling. The Russell is also up. The Dow is up. The reason that the Russell is outperforming is because what is allowing us to rally this morning, and that is Treasuries. 30-year yields still holding on to their declines, down 9 basis points as Treasuries rally after the Treasury said that they would double the size at least of buybacks on the long end of the curve. They say it's for liquidity. Gold also rallies off the back of that. The dollar sinks. Nvidia shares are down this morning. Again, part of the reason that tech is down. SK Hynix, though, they're up with the company buying back more shares. So a lot of soothing things by buying back various instruments this morning. Merck and Moderna together announcing a key treatment for cancer, an mRNA vaccine that helps stop the reoccurrence of melanoma. Moderna, Sam Vazzelli was telling us that there are a lot of shorts on this stock, so you're seeing some short covering along with the big rally on this breakthrough treatment. Nebius, an issuance from them means shares come down. Oracle, so much pressure on data centers. We learned that Pennsylvania is also the latest to restrict data center development, so Oracle falling off the back of that. Coming up, Betterment CEO Sarah Levy discusses their new survey on Gen Z and sports betting. This is Open Interest. A new survey from Betterment found that Gen Z is blurring the lines between sports betting and investing. More than a quarter of Gen Z investors see gambling on sports as part of their long-term financial strategy, and half have pulled money meant for investments to bet on sports. For more details, let's bring in the CEO of Betterment, Sarah Levy. Sarah, should we be concerned about this?
I mean, it's not a great fact, right? So I think, gambling has always existed. And as we know, the casino always wins. So my feeling is gambling's okay, but it should be part of your entertainment budget, not part of your long-term savings goals.
Well, what's happened that's blurred the lines? Again, if they're seeing this as an investment, what in the sports betting universe has made this, I guess, we have more accessibility from apps, but why is this mentality forming?
Well, I think accessibility is exactly the right answer, right? And I also think it's the proximity to investment apps that they trust. And so it's not just that it's widely available, it's that it's literally sitting alongside places where you can save for your retirement. And I think it's really sort of a dangerous trend. As a fiduciary, I think our preference would be that these things were a little more separate so that people understand the difference.
So what do you do in this scenario as a steward of so many people looking to invest, prepare for retirement? Is there a lot of work that someone like a Betterment can do, or does this maybe come down to policy to try to put clear divides between sports gambling and investment?
I think it's a great question, and I think ultimately it will be hard for the fiduciaries alone without any regulatory oversight to create that separation, because as most of us know, gambling is lucrative for the casino, right? And so I think, we at Betterment are not going to pursue this strategy at all, because we really believe in setting people up for the right long-term future, and particularly in an age where we're not sure if Social Security is going to get the job done for this next generation. It's incumbent upon folks not to take that extra $100, if they even have that $100, and put gamble it away when they should be really, setting themselves up for a positive future.
Sarah, does this mentality, though, seep into things like equity investing? Already post-pandemic, you had the rise of things like Wall Street bets, where people were taking big punts and putting a lot of their life savings on YOLO trades. Does that continue to get worse if you have a populace, especially a younger one, who are used to doing gambling-type activities with their finances?
I mean, look, I take the I'm going to follow your lead and agree with you, which is
you can disagree, Sarah. By the way, you're definitely allowed to.
No, I'm sure I can. I think that I really genuinely believe this is not a good trend, but I also think we can't sort of fight gravity. And so what we have to understand is like, what's the mentality of this generation? Where are they getting their information? They're getting it from AI. They're getting it from social media influencers. Some of these social media influencers, know what they're talking about, and others don't, and are just, sitting on top of a fancy car, kind of trying to sell their wares. And so you can't fight gravity when this generation wants to get their information in those places. I think what we can do is we can educate, and we can look for some regulatory oversight to help us really create a distinction between what does it mean to set yourself up for a successful future and what is gambling, which is really entertainment.
It's a great point. In your study, you have 60% of Gen Z get their financial news from social media, which is also maybe bad news for myself, who hope that Gen Z also watch this show and get some of their financial news from that too. Sarah, what does that mean for example, you just launched this custom portfolios. You let users pick from over 5,500 individual stocks. How do you do that in a way by giving them this power, but also making sure they don't abandon basic things like portfolio diversification?
So what we're trying to do is create guardrails and a structure in which they can have flexibility. And so if you turn back the clock 15 years when Betterment first started, we were a set it and forget it, we'll take care of it, right? We'll figure out your portfolio, we'll put you in the right kind of long-term answer, and then we'll automate for all sorts of, tax savings and other benefits. I think what we saw, to your point, like during COVID, is once there were zero commissions on trading, the self-directed investing phenomenon really took off. And so the question we asked ourselves is, how do you sort of meet in the middle, which is give these investors the flexibility to sort of vote with their own wallets and make their own decisions, but then set it up within a structure that can help them carry that forward and provide some AI, even some AI insights, right, to help them understand the choices they're making.
Sarah, before I let you go, we should probably talk about an audience that hopefully is watching the show, and I would assume so, not turning to TikTok for financial advice, and that's Gen X. Also in your study, they had the lowest retirement confidence of any generation at 31%. It's peculiar at a time that markets are at all-time highs. Why do you think Americans, and specifically Gen X, are feeling less secure about retirement?
So I think the real issue for Gen X is that they're getting closer to retirement, and they're seeing that their nest egg is maybe not what they had hoped 20 years ago. Maybe they got started too late. I mean, overwhelmingly what we're seeing with all the generations is that folks regret starting too late. And so I think Gen X is basically thinking, okay, my career is in the back half, and now I don't have many more years to save. And wow, is my money going to stretch when the cost of living is so much higher than it was when I started saving, a few decades ago?
Hey, Sarah, we're going to have to leave it there. So great to catch up with you. Really interesting study. Betterment CEO Sarah Levy. Let's get a check on your equity market this morning, over an hour into your trading day. We are seeing stocks off the highs. The S&P up 0.4%, specifically the NASDAQ, though. That thing says NVIDIA falls, Oracle falls. There seems to be some pressure building around data center adjacent stocks, considering the pushback we're getting as we head into this midterms of being able to actually build data centers. We'll have more on that conversation at the end of the hour. But you also are seeing the thing supporting this market, 10-year yields. Those are falling by 6 basis points. Even more extreme on the long end of the curve as the Treasury steps in to boost a buyback on the long end of the curve, doubling it at the very least. Brent crude, that's still trading above $91 a barrel. Let's look at some of the other movers this morning. With that is Nora Melinda. Hey, Nora.
Hey, Dani. Let's start with retail. Shares of Target hitting their highest level in nearly 2 years. The company lifted its full-year guide with Target in the midst of a sales turnaround after 3 straight years of declining revenue. The stock's up more than 60% year-to-date, up about 4.7% this morning. And Lowe's also in the green. That's even after cutting its forecast. Analysts say weaker sales were already priced in, and the lower forecast could make it easier for Lowe's to surprise from here. Shares of the company up about 4.7%. 4% this morning. And finally, Merck and Moderna are both jumping on promising results for their experimental skin cancer vaccine. And when I say jumping, Moderna is up triple digits, actually up about 96% right now. The vaccine cut the risk of melanoma coming back. So that's why you're seeing both stocks being rewarded. Those are your morning movers. Dani?
Nora, thank you very much. Coming up on the show, we're going to be speaking with the TrueCar CEO, Scott Bessent, about what tariffs could mean for car prices. That's coming up next. This is Open Interest. That was Democratic Socialist Angie Nixon after her surprise win in Florida Senate primary. The primary setting the stage for November as Trump-backed Byron Donalds wins the Republican primary for governor. Let's get the latest with Bloomberg's Kayleigh Lyons, co-host of Balance of Power. Kayleigh, what signals did we get from this Florida primary?
Well, Byron Donalds winning the gubernatorial nomination on the Republican side, while a historic first, he is obviously a black man, and we've never seen that before in Florida, is largely the expected outcome of that. He will go up against David Jolly in November. What was the unexpected outcome was the victory of Angie Nixon, who we just heard from, a member of the DSA who ascribes to ideas such as universal child care and Medicare for all, handily beat retired Lieutenant Colonel Alex Vindman, who you'll remember from the first impeachment trial of President Trump, where he was a key witness. She beat him by 12 points, despite having a massive fundraising disadvantage. He had about 10 times the amount of money she did, $9 million in the bank. She had less than $1 million, wasn't able to spend as much on TV advertising, and still came out on top, which points to the energy in the far left realm of the Democratic Party, which has stricken a lot of fear into the establishment over concern that these are the less electable candidates in the midterm. She will now go up against the incumbent Republican Ashley Moody. In Florida, Sabatos crystal ball at the University of Virginia Center for Politics now has moved that race from a lean Republican to a solidly Republican. The idea is that this is now even a longer shot, not that it was by any means an easy Democratic flip opportunity in the first place, but now it seems more likely that that seat will be held in Republican hands. I will note, though, Dani, it wasn't a sweep for Democratic Socialists in Florida yesterday. You had the incumbent Congressman Jared Moskowitz, the Democrat who is one of the more prominent Jewish voices on Capitol Hill, handily dispatched his DSA opponent. He won by nearly 30 points.
Kayleigh, elsewhere, we saw the president saying in the 11th hour of needing to put tariffs back on Canada that there would be a three-day reprieve. What do we know about the status of any tentative deal between the two countries?
Well, it is tentative, Dani, and yes, at the 11th hour it was. The president posted this on Truth Social at approximately 10:15 last night, when these 50% tariffs on billions of dollars of goods were supposed to go into effect at midnight. So this really was at the last second. As you said, it's now a 3-day period to try to finalize a deal that, at least on the Trump administration side, they are describing as one which Canada has committed to remove discriminations on U.S. goods such as dairy, alcohol, and U.S. autos. The U.S. Trade Representative Jamieson Greer's office in a statement said that the deal includes comprehensive market access for all American goods, as well as economic security commitments and digital trade alignment, as well as other factors. We don't have a lot of specifics on that. We don't have specifics as well as to how the Keystone XL pipeline, which of course runs from Canada into the United States, factors in here, though President Trump did comment on that in his Truth Social post, saying that could be reawoken from the grave. And I would note as well, Dani, just as a word of caution, we aren't necessarily getting the same kind of rhetoric out of Canada about how close a deal is. Mark Carney's office, the prime minister, is essentially saying that they're still just working with the United States, and we'll see what happens at the expiration of this 3-day period, Dani.
Kayleigh, thank you very much for that. Looking forward to Balance of Power. That's Kayleigh Lyons, the co-host of Balance of Power. Catch her at 1 p.m. and then again at 5 p.m. That tariff uncertainty, it's putting the auto industry back in focus. Automakers have largely absorbed the added cost so far, but TrueCar CEO Scott Bessent says there's a limit to how long that can last. He joins us now. Scott, on that, if ongoing U.S.-Canada trade talks do stall, how quickly can companies pass along or absorb any new tariffs?
Well, sure. when you put a tariff in place, it adds cost to the system, and it has to go somewhere. Ultimately, if it affects affordability, I mean, affordability is really focused on understanding how consumers shop and ultimately buy cars. They tend to be price shoppers, but they are payment buyers. There are 4 transactions that go on when you buy a car. It's not just the car, it's the financing, the insurance, which is affected by regulation, and then you've also got trade-ins. What's happening right now, and what we see in Canada, they're not just another country in this equation. Canada is part of a North American manufacturing system, and who wouldn't want more, U.S.-focused manufacturing capability and supply chains moving towards America? It's just those tend to be longer-term strategies, whereas what we see at TrueCar, where we are a new car auto buying platform, we see millions of consumers every month, we see a real shift, and it's very, very immediate from the consumer backwards. We've seen a mix shift from new to used, and we've also seen hybrids pick up a lot of interest, almost 3x their normal interest. Over the course of this year, since the war started in Iran, we have seen almost a 50% drop off on new car searches. And then we also see customers looking for value by looking for used cars and lower prices. So those kinds of immediate behaviors make us sort of a canary in the mine. We're seeing that happen in real time. Fortunately, I think that the automakers, like you mentioned, are the first line of defense. They have been able to successfully absorb most of this. And ironically, right now is the best time, if you've got good credit, to buy a new car. There are more incentives right now than we have seen in the automotive century over the last 110 years.
I'm guessing, Scott, so that's also an acknowledgement, not only that the incentives are good right now, but prices are just going up from here.
Prices are definitely going to go up. However, affordability doesn't necessarily go up just because prices go up. Again, if interest rates remain high, so 94% of consumers do not pay cash for a car. They are either financing or leasing that vehicle. If you've got above a 700 FICO, you're going to be leasing a vehicle on the new car side. But a new car is a great value when discount levels are very high. So in reality, it may be a very good time, even though prices are likely to go up, to buy a new car versus a used car. Right now, the real winner is the consumer when they're looking at a new car with a discount or an incentive from an OEM or a used car buyer. So this bodes very well. One of the other unintended consequences is when used cars become very popular and they're in high demand, they become a lower supply item, prices go higher, residual values are retained, and that is also part of the equation in financing and leasing, and therefore you bring down prices a little bit on the front end. So it's a very important and complex system, but today we are seeing a very soft new car market, and whether it's high gas prices or high insurance costs or the high price of a car, all of those things are forcing the manufacturers to heavily incentivize new car purchases just to stay in the game.
Scott, I only got about a minute here, but to the day's news of a 3-day reprieve of any additional tariffs on Canada with a tentative deal apparently in the works, does it relieve at the moment any supply chain pressures, at least in the intermediary?
No, all of the supply chain issues are long-term issues. Auto manufacturers tend to plan not just months and quarters, but years ahead. So these kinds of things take a lot of time. Again, I think it's well-intentioned, but I think this is all part of a negotiating strategy that we're witnessing from the front row. It creates tremendous uncertainty, which is by far the bigger, more negative impact on the auto industry. Automakers can almost price in any kind of risk if they have some kind of stability. It's really this cagey sort of back and forth that makes it very, very difficult. Again, there's a way to navigate this as a consumer. One thing that we're definitely seeing, though, is while there is a mix shift from new to used, from premium to mainstream, from large to small, from I'll buy now to I'll buy later, all of those things are happening for sure, but the demand for mobility is not dropping. Consumers need cars to get to work. 3 out of 4 Americans need a car to get to work every day. And so the need for mobility means that we've got a robust market. It's just a matter of what's going to be selling.
Scott, great to have you on this morning. Appreciate it. TrueCar CEO Scott Painter. Coming up on the show, big tech mounts a charm offensive to win over communities as AI opposition data centers specifically. As that starts to grow, we're going to have more on that story coming up right after this break. Big tech companies are deploying aggressive pro-data center PR efforts to try and rally support for data centers that are proving to be largely unpopular in local communities. For more, Bloomberg's Brody Ford has been doing in-depth reporting on this topic. He joins us now. Brody, this reporting is so good, and it's perfect timing, too, because we just learned that Pennsylvania Governor Josh Shapiro is also limiting the ability to build data centers in Pennsylvania. So what are the data center companies, the oracles of the world, trying to do to overcome the souring political and local pushback?
We got to remember that for, a decade or two, every town wanted a tech company there. They wanted to feel like they were part of this boom that in the 2010s seemed to only, benefit San Francisco or benefit New York. And so for a long time, towns were doling out tax breaks and trying to lure the data centers. And as you said, that has changed so quickly, and data center companies, AI companies have found themselves needing to convince towns that they're good to have and that they shouldn't ban them and that they should allow to build the data centers there. And so far, it's been tough going. 75 projects have been halted this year from local opposition, and so it is really an uphill battle for many developers right now.
You detail some really interesting case studies of Oracle, for example, in Doña Ana County. 230,000 people live there, and they've become integrated into daily life, donating money, local organizations sponsoring events. In those specific communities, Brody, what is the public attitude towards Oracle, for example? Does that help improve both their life and their attitude towards the company?
I mean, we've seen a lot of pretty funky backlash. Like, I think my favorite example is their big data center there is Project Jupiter, and a lot of people will be like, oh, it's Project Stupider. I mean, it's silly stuff, but it's very wide-ranging. I have some family who lives in Michigan near Detroit, and right now all they're hearing about is the big Oracle data center in Saline. And so it's a largely unpopular to have this infrastructure, but the companies are trying very hard to change that. Oracle, known for having a bit of a win at all costs, hard-charging Larry Ellison approach, but now they're sponsoring rodeos and concerts and saying they're going to give all this money to boys and girls clubs. And so they're really needing to change their public face.
And presumably politicians are pushing them to do the same thing. Axios had a story today that the GOP has been warning AI companies that they need to do more because they've become politically radioactive. Brody, what is the intersection of politicians and the AI companies at this point, considering we are heading into the midterms and are underway with various primaries throughout the country?
We've seen a lot of these sort of performative statements. I think the Josh Shapiro in Pennsylvania is the most recent one. Putting out some language that sounds very tough, that we're going to make sure these data centers, don't mess up your water, your power grid. And it's still a bit unclear what material changes will happen. I think water is one of the concerns you hear constantly. A lot of the new AI data centers don't use a ton of water. It is closed loop. I think the power grid is the more real fear for a lot of people in this space, that you're bringing on just gigawatts of power many times through gas in a way that, the grid hasn't had this kind of upgrade in a long time. And there is a lot of feeling of, hey, if data center companies are bringing this much power online, they need to really be held responsible for what happens if there are any issues. And so I think that's some of the big political tripwires, and I'd expect this to be just a major campaign point as we head into election season.
Brody, this was such a good read. Thank you for bringing us your reporting. I hope you write a book about this, because I thoroughly enjoyed it. Really recommend everyone else go and read Brody and the team's reporting. Brody Ford from Bloomberg News, thank you so much. Let's get a check on your markets as we head to the end of the hour. We're still rallying in the S&P after the Treasury announced that they were doubling buybacks, at least doubling it on the long end of the curve. 30-year yields move lower as those bonds rally by 9 basis points. Catch me at 12 p.m. on Bloomberg Deals. I've got an exclusive interview I will bring you with Matt McClure, the global co-head of investment banking at Goldman Sachs. That does it for Open Interest. See you tomorrow.